Welcome back to the deep dive. Today we are digging into a really big question, looking at a stack of sources trying to figure out the real investment case for Ethereum.
Yeah, it's fundamental, isn't it? We're asking, is ETH, a sustainable long-term hold,
Hmm.
something foundational?
Or is it still maybe more of a high-risk play that just kind of rides the bull markets?
And that difference, well, it's critical for you listening
Yeah.
because our sources today, we've got everything from official Ethereum notes, Vitalik Buterin's blog posts, right down to on-chain data from Glassnode, Masari,
A real mix.
a real mix, and they all push us to look past just the price ticker. Ethereum isn't just trying to be digital money. It's designed really as this base layer, this backbone for DeFi, NFTs, smart contracts.
So our goal here is to pull out the main arguments from these sources, look hard at the economics, like that deflationary stuff, weigh up the institutional interest against, the real risks, competition, regulation.
Definitely. We're synthesizing here, not giving financial advice. We want to give you a clear picture of what the research stack says about Ethereum's fundamentals and where it sits in the market.
Okay. So where do we start? To understand the investment case, we first need to get what makes Ethereum. Well, Ethereum, different from Bitcoin.
Exactly. Why does it even exist? It starts with its unique value prop. Bitcoin was about digital scarcity, right?
Digital gold.
Ethereum brought us the smart contract. And that technology is really the spark for pretty much all of Web3. Programmable money. That's the key concept.
Explain that a bit more. What's a smart contract, really?
Well, think of it like self-executing code.
Hmm.
It automatically enforces an agreement when certain conditions are met. No need for a middleman, like a lawyer or a bank.
So if X happens, then the contract automatically does Y.
Precisely. And it's written onto the blockchain, so it's immutable, transparent. Now, the crucial bit is this turns ETH, the token, into a utility. You actually need ETH, they call it gas, to pay for the computation that makes these contracts run.
Okay, so the token isn't just for speculating, it's fuel for the network.
Exactly. And this utility, this programmability, is what let Ethereum basically become the home for two massive ecosystems. You mentioned them, DeFi, decentralized finance.
And NFTs, non-fungible tokens. The sources are pretty clear. Most of the big innovations in those areas, they started on Ethereum. Huge first mover advantage.
Massive. But, to keep that lead and actually handle potentially global scale, the network itself had to evolve. And the sources really zero in on two massive upgrades. The first one, everyone's heard of it, the merge.
Right, the big shift away from proof of work, that energy guzzling system Bitcoin uses.
Proof of stake, or POS. Now, the environmental angle got all the headlines, which is fair
A
enough.
huge reduction in energy use, yeah.
But the economic shift, from an investment standpoint, was just as profound, maybe more so.
How so? What changed fundamentally with POS?
Well, the whole security model flipped. Instead of miners spending electricity, you have validators staking their own ETH, locking it up as collateral.
So their own money is on the line.
Their own money. If they try to cheat the network, their staked ETH gets slashed, basically penalized. It creates this really strong economic incentive to act honestly. And critically, the merge slashed, forgive the pun, the issuance of new ETH by something like 90%.
90% reduction in new supply. Wow.
Yeah. It dramatically slowed down the inflation rate. And that sets up the whole ultrasound money thing we need to get into later.
Okay, so the merge addressed security, energy, and inflation. But it didn't fix the network's biggest headache, right? Scalability. Things still get slow and expensive.
Exactly. Which brings us to the next big upgrade the sources focus on, dank sharding. Sounds super technical, I know.
Yeah, break that down for us.
Okay, so dank sharding is Ethereum's long-term plan for scaling, but it's different from how some competitors try to scale. They often go for a monolithic approach, try to make one single chain do everything faster.
Ethereum is doing something different.
Yes, it's modular. Dank sharding isn't about making the main Ethereum chain itself process everyday transactions super fast. Instead, it's specifically designed to make things way cheaper and easier for Layer 2 scaling solutions. Rollups like Arbitrum, Optimism.
Right, the L2s that bundle transactions off-chain. How does dank sharding help them?
It introduces something called blobs. Think of them as big, cheap chunks of data space specifically reserved for these rollups. Right now, when an L2 posts its compressed transaction data back to the main Ethereum chain for security, it has to compete for space with regular transactions, and that gets expensive.
So blobs give them their own dedicated, cheaper lane.
Exactly, a massive data lane. So Layer 2s can dump their data onto Ethereum much more cheaply. And that cost saving should, in theory, trickle down to you, the end user, making transactions on that L2 potentially dirt cheap.
Okay, so cheaper L2s mean Ethereum can actually scale for potentially billions of users, handling things like microtransactions, gaming, social media, stuff that's just too expensive on the main chain now.
That's the vision. The success of dank sharding is absolutely critical. It's how Ethereum plans to become that world computer people talk about without sacrificing its core security. This technical stuff directly feeds the investment potential. If it works, mass adoption becomes feasible.
Which leads us nicely into the bull case. If the tech roadmap holds up, what makes ETH itself a compelling investment? Let's talk about that ultrasound money idea.
Right, ultrasound money. It's a direct response, almost a meme, contrasting with Bitcoin's sound money or digital gold narrative. Bitcoin's value proposition relies heavily on its fixed supply, only 21 million ever, anti-inflationary.
Okay. But Ethereum doesn't have a fixed cap, does it?
No, it doesn't. But thanks to a crucial change called EIP 1559, which went live back in August 2021, Ethereum can actually become deflationary. The supply can actively shrink over time.
EIP 1559, that's the one that changed the transaction fees, right? How does that work again?
Okay, so before 1559, you basically bid in an auction to get your transaction included, and all the fee went to the miners. Very unpredictable, often expensive.
Yeah, I remember those days.
Gas scores.
Exactly. EIP 1559 split the fee. Now there's a base fee, which the network sets automatically based on how busy it is, and then there's an optional priority fee, or tip, you can add to jump the queue.
Okay, so where does the burning come in?
The base fee. This is the magic part. That base fee isn't paid to the validators, the guys running the network now. It's simply burned, destroyed, permanently removed from the total supply of ETH.
Gone, just like that.
Poof! Gone. Only the small priority fee, the tip, goes to the validators as their incentive.
So wait, if the network gets really busy, like during a huge NFT mint or some crazy DeFi action,
The base fee automatically goes up to manage congestion.
and if the base fee goes up, more ETH gets burned.
Precisely. And here's the kicker. If the amount of ETH being burned via this base fee is greater than the amount of new ETH being issued to validators for staking.
Then the total supply actually goes down. Deflation. Bingo. That's the ultrasound money thesis. Scarcity driven not just by a fixed cap, but by the utility of the network. The more people use Ethereum, the more ETH gets burned, the scarcer it potentially becomes. The on-chain data shows this happening quite consistently during periods of high activity.
That's a powerful economic feedback loop. Utility drives scarcity.
It is. And it's clearly not just retail speculators noticing this. The sources really hammered the point about institutional adoption moving beyond just talk.
Right. This isn't just crypto-native stuff anymore. We're seeing big traditional players actually building on Ethereum.
Yeah, this is a huge part of the bull case. Take Visa, for example. The sources detail how they're actively experimenting with using Ethereum, specifically with stablecoins like USDC running on Ethereum for settling cross-border payments between their partners. Faster, potentially cheaper settlement.
Using the public Ethereum blockchain.
For parts of their pilots, yes. It shows they see the potential of this public infrastructure. And it's not just payments. Look at the banks.
JP Morgan.
JP Morgan's Onyx division. They're deep into experimenting with tokenization, using private versions of Ethereum tech, but also interacting with public chains. They're testing how to put real-world assets like bonds, maybe even internal money market funds, onto blockchain rails for instant settlement.
So they see the smart contract capability as a better way to manage complex financial assets.
Exactly. It's recognition that this isn't just internet funny money. It's potentially a new operating system for finance.
And all this real-world experimentation, this building, it sort of paves the way for the next big potential catalyst, Ethereum ETFs.
Spot on. Following the Bitcoin ETF approvals, the expectation, according to these sources, is very high for spot Ethereum ETFs, maybe later this year or next.
And what would that mean practically?
It's huge. An ETF is a regulated, familiar wrapper. It allows massive pools of traditional capital, think of pension funds, endowments, wealth managers, who can't just buy ETH directly on an exchange to get exposure easily through their brokerage accounts.
So it opens the floodgates for institutional money.
Potentially, yes. It's not just about the inflow of cash, though. It's also about the signal it sends. Regulatory acceptance, or at least tolerance. It adds a layer of legitimacy, positioning ETH alongside Bitcoin, maybe even gold, as a recognized investable asset for serious portfolios.
Okay, so we have the potential deflationary economics, real institutional building, and the prospect of ETFs. But there's another key strength the sources mention: The ecosystem itself, the developers, the liquidity.
This is maybe Ethereum's biggest, stickiest advantage, its moat, if you will. When you look at the sheer number of active developers building on Ethereum compared to any other layer 1, it's not even close.
Thousands and thousands of developers.
Yeah, and along with that comes mature tooling, libraries, educational resources, established standards like the ERC20 token standard.
Yeah.
It's just easier and more efficient to build complex applications on Ethereum right now.
And that attracts more developers, which attracts more projects, which attracts users and capital.
Exactly. It's that classic network effect.
Yep.
It becomes self-reinforcing. Developers build where the users and the money are. Users go where the cool apps are. Capital follows the innovation. It makes the ecosystem incredibly sticky. It's hard and expensive for projects and liquidity to just pick up and move somewhere else.
That network effect is powerful. And, speaking of support and building things, if you're finding this breakdown valuable, hitting that like button, subscribing, maybe leaving a comment, it really does help us. It tells the algorithm people are interested and lets us keep doing these deep dives into the crypto space for you.
Yeah, it makes a difference. So building on that network effect, let's look back historically. How did Ethereum build this lead? The sources point to some key moments. DeFi summer is the big one.
Right, 2020, that felt like the Cambrian explosion for decentralized finance.
It really was. Before that, DeFi was niche. DeFi
Yeah.
summer showed it could be a real, functioning, alternative financial system, all built on Ethereum's smart contracts.
What were some of the breakthrough projects from that era?
Oh, you had giants born then. Uniswap, which pioneered the automated market maker, or AMM, totally changed how token swapping worked. No more order books for many pairs.
Just liquidity pools. Game-changing.
Completely. Then you had lending protocols like Aave and Compound. Aave introduced things like flash loans, uncollateralized loans you had to repay in the same transaction block. Sounds crazy, but it enabled all sorts of complex arbitrage and trading strategies.
These weren't simple apps. They were complex financial machines running entirely on code.
And managing billions of dollars in value, all launching and finding their footing on Ethereum first.
And we can actually track that dominance with data, right? Like total value locked, TVL.
Exactly. TVL measures how much money is locked up in a specific protocol or blockchain's DeFi ecosystem. And while competitors definitely have periods of growth and height, the charts consistently show Ethereum holding the vast majority of the deep, long-term capital in DeFi.
Why is that? Why does the money stick there?
The sources argue it boils down to trust and Lindy effect. Ethereum has been battle-tested for longer. Its security model is perceived as more robust. So if you're deploying serious capital, billions of dollars, you tend to favor the most secure, most proven environment, even if it's a bit slower or more expensive sometimes.
Okay, so DeFi established Ethereum as the financial layer. But then came the next wave, which brought in a totally different crowd, NFTs in 2021.
Yeah, the NFT boom was massive for demonstrating Ethereum's versatility. It proved it wasn't just for finance nerds. It could be the foundation for digital culture, ownership, identity.
And again, Ethereum was ground zero. CryptoPunks, Bored Ape, Yacht Club.
The icons. These weren't just JPEGs. They became cultural status symbols, digital identities, access keys to communities. And they launched and primarily traded on Ethereum. Marketplaces like OpenSea, built on Ethereum, became dominant.
Even when other chains offered cheaper minting or faster transactions for NFTs, the high-value stuff, the blue chips, largely stayed on Ethereum or its associated layer 2s.
That's right. It cemented Ethereum's reputation as the high-value chain, the chain for assets that really matter, whether financial or cultural. It proved it could host these viral, globally recognized applications.
So let's connect the dots for the investment case. If Ethereum keeps this dominance in both finance and culture, what does that imply for the value of ETH itself?
Well, the argument is straightforward. If all this economic and cultural activity continues to happen on Ethereum, it drives persistent demand for ETH as gas to pay for transactions. It drives demand for ETH to be staked to secure the network. It reinforces the EIP 1559 burn mechanism, potentially making ETH deflationary.
So past success fuels future demand, which fuels the asset's value proposition through staking rewards and that deflationary pressure.
Exactly. And it also drives the adoption of layer 2s because as the main chain gets more valuable and maybe more congested, activity naturally moves to those cheaper, faster layers that still rely on Ethereum for final security. It's a whole interconnected system.
Okay, that's a compelling bull case built on utility, tech upgrades, institutional interest, and network effects. But we absolutely have to look at the other side. What are the major risks and concerns? What could derail this?
Number one, without a doubt, is still scalability and gas fees. It's the recurring criticism.
The Achilles heel, as you called it earlier.
It really is. Despite the promise of L2s and dank sharding, the user experience on Ethereum mainnet can still be rough during peak times. Gas fees can spike to levels that make small transactions totally uneconomical.
We've all seen those crazy gas fee charts during mints or market volatility.
Yeah, and this leads to that critical question the sources wrestle with. Can Ethereum truly be the world computer if using the base layer is often prohibitively expensive for the average person? Or does it just become a settlement layer for whales and L2s?
And is relying on layer 2s a perfect solution?
Well, that's the debate. The roadmap is L2-centric. The idea is Ethereum L1 provides ultimate security and decentralization, while L2s provide the scale. Dank sharding is meant to make this seamless and cheap.
But doesn't using L2s introduce new complexities? Bridging assets, maybe different security assumptions depending on the L2.
That's the valid critique.
Yeah.
It fragments the user experience. Instead of just using Ethereum, you might be using Arbitrum, or Optimism, or ZK Sync. Each might have its own nuances, its own potential bridging risks, although technologies like ZK rollups aim to inherit Ethereum's full security.
It's not as simple as just using one chain.
It isn't.
Yeah.
And that complexity, that fragmentation, opens the door for competitors who offer a simpler, more unified, high-speed experience on a single layer.
Which brings us neatly to the competition, the so-called ETH killers.
Right. While Ethereum was grappling with scaling via L2s, other Layer 1 blockchains took a different approach. They went for monolithic scaling, designing the base layer itself to be super fast and cheap from the get-go.
Who are the main contenders the sources point to?
Solana and Avalanche are frequently mentioned. Solana in particular, with its unique proof-of-history consensus, achieved incredibly high transaction speeds and low fees early on. They captured significant market share in areas like high-frequency DeFi trading, some gaming applications, areas where low latency is absolutely critical.
So the risk scenario is, if these faster, simpler L1s continue to innovate and capture the next wave of killer apps, maybe in areas like DePIN, decentralized physical infrastructure networks, or the metaverse, or mass market gaming.
Then they could siphon off significant economic activity that might otherwise have landed on Ethereum or its L2s. And since ETH's value is tied to that utility, to that demand for gas, losing market share in key growth sectors would definitely impact its long-term investment case.
It's a battle of architectural philosophies, almost. Modular security first versus monolithic speed first.
That's a good way to put it. Investors need to weigh which approach they think wins out in the long run for attracting developers and users globally.
Okay, scalability and competition are huge technical and market risks. What about the external risks?
Regulation. The ever-present elephant in the room for crypto. Regulatory uncertainty is a massive overhang, especially for Ethereum.
More so than for Bitcoin. Why?
Mainly because of the ongoing debate about whether ETH should be classified as a security or a commodity, especially after the merge and the move to proof of stake.
Okay, unpack that. Bitcoin seems to have mostly cleared the hurdle, generally viewed as a commodity like gold. Why is ETH different?
It comes down to staking. Regulators, particularly in the U.S., look at things through the lens of the Howey test to determine if something is an investment contract and therefore is security. One prong of that test involves an expectation of profits derived from the efforts of others.
And staking ETH earns rewards.
Exactly. Some regulators might argue that staking ETH, locking it up with validators who run the network, and earning staking rewards looks like an investment where you expect profit based on the efforts of those validators and the core developers managing the protocol. That could push it towards being classified as a security.
And if ETH is deemed a security, what happens then?
It would be a massive shift. Staking services, exchanges listing ETH, DeFi protocols interacting with it, they could all fall under much stricter, more complex securities regulations. It would likely hinder innovation, reduce liquidity, and make it much harder for traditional institutions who need absolute regulatory clarity to get heavily involved beyond maybe just holding an ETF.
So that uncertainty is a major blocker for big, cautious institutional money.
It's definitely a significant factor slowing things down. While the ETF provides a regulated path, broader integration into the financial system faces this hurdle until there's clear regulatory guidance.
Okay, so real risks: scaling, competition, regulation. But despite these, the overall tone from the sources seems to lean towards strong long-term potential, assuming execution. Let's try to synthesize this for the listener. What's the fundamental difference in the investment thesis between ETH and BTC?
That's the absolute core takeaway. Bitcoin's narrative is digital gold. It's about being a provably scarce, secure, neutral store of value, a potential inflation hedge, a digital equivalent to gold in a portfolio. Its value comes from that scarcity and security.
Okay. And Ethereum?
Ethereum's investment case, according to these sources, is fundamentally different. It's less about being just digital gold and more about owning a piece of the internet's future infrastructure. Owning ETH is like owning shares in the foundational layer of Web3.
So its value isn't just scarcity, but driven by the demand to use the network.
Exactly. The value is tied directly to the economic activity happening on top of it. The demand for ETH as gas to power DeFi, to mint NFTs, to run DAOs, to secure layer 2s that utility demand is what theoretically drives the price and the burn mechanism. You're betting on the growth of the entire decentralized economy built on its rails.
You can kind of see that in the market sometimes, right? When things are risk-off, Bitcoin might hold up better as digital safety, but when there's excitement about new apps and Web3 growth, ETH often catches a stronger bid because it powers that innovation.
That's often the dynamic, yeah. So if we boil down the potential scenarios from the sources for you, the investor, scenario A, Ethereum executes well in scaling with dank sharding, L2s flourish, institutions continue to build and adopt via things like ETFs and tokenization. In this case,
The prediction is bullish. Continued growth in staking yields, ETH potentially becomes more deflationary. It solidifies its place as the dominant smart contract platform and settlement layer.
right. Scenario B, the scaling roadmap falters, L2s remain clunky or fail to gain mass adoption, or competitors like Solana or others genuinely steal significant market share in key growth areas like gaming or social.
Then the investment case weakens. Less network activity means less demand for gas, less ETH burn, potentially lower staking yields. The value proposition based on utility erodes.
So the bottom line from synthesizing all this research is, Ethereum is definitely not a risk-free bet. Its success hinges on continued technical innovation and execution.
But its existing network effects are immense. Its track record in birthing multi-billion-dollar industries like DeFi and NFTs is undeniable, and its position as the most secure and decentralized smart contract platform gives it a very strong, unique foundation.
It's essentially an investment in the core utility layer of a potentially massive future decentralized internet. That's the long-term potential you're weighing against the risks.
Perfectly summarized.
Okay.
That leads us to our final thought, something for you to really mull over based on everything we've discussed.
Right. We talked a lot about dank sharding making the base layer cheap and robust, enabling layer 2s to scale massively. Assume for a moment Ethereum pulls this off. Assume institutional adoption continues. We saw DeFi emerge. We saw NFTs emerge. What's the next totally unforeseen, maybe even unimaginable killer application that becomes possible only when you have this super secure, globally accessible settlement layer with incredibly cheap data availability provided by blobs?
What becomes possible when the cost of using that secure base layer plummets? Is it truly decentralized social media that can handle billions of users without censorship? Is it global digital identity systems? Is it something related to AI interacting on chain? What's the next big thing that this infrastructure unlocks?
And if that next killer app does emerge on Ethereum, leveraging that cheap, secure foundation, what is owning a piece of that foundational infrastructure ultimately worth? Something to think about.
Definitely something to think about. That wraps our deep dive today into the investment case for Ethereum. We hope breaking down these sources gave you a clearer perspective on the technology, the economics, and the risks.
Thanks for joining us.
We'll see you on the next deep dive.